Hello, welcome to the first quarterly investment video from Yachting Financial Solutions, YFSOL Partnership and Momentum. I'm Clive Evans, as you probably know, Chairman and Founder of Yachting Financial Solutions. And with me, I'm joined by Glynn, Owen and Andrew Hardy from Momentum Asset Management in the UK, in the heart of the City of London. You can see St Paul's from their office. It's a fabulous view, and they do a great job looking after an awful lot of other people's money, including a lot of yours. They've got some interesting things to tell you about the markets at the moment and the world that we're living in. It's going to be especially interesting for me because I've been on holiday for 2 weeks, so I have no idea what's been going on whatsoever. So let's go straight across to Glynn and find out what's happening. What's happening, Glynn?
Well, quite a lot, Clive, has been happening in markets in recent weeks. The news flow in the past 3 months has generally been reasonably good in terms of economies doing better than people thought. They haven't gone into the recession that people were predicting. There's still some growth. Inflation has been coming down, perhaps not as quick as people expected. So there's been a little bit of uncertainty about that. And central banks have continued to tighten policy. And the impact of that policy tightening, particularly by the Federal Reserve Bank in the States, by far and away the most important central bank in the world, is beginning to have some impact. And that's what we've seen in recent days with the collapse of two banks in the US.
Wow.
Whenever you get monetary tightening,
that sounds a bit scary.
It is a bit scary when you, particularly if you're a depositor with those banks. They weren't minnows, they weren't large banks, but they weren't minnows. So one is based on the West Coast. It's called Silicon Valley Bank. Guess what they do? Their client base is tech startups and very small growth companies. And they fell into difficulty when deposits ran down and actually collapsed on Friday of last week. And then a second bank on the East Coast, similar sort of thing. They were heavily into the crypto world. They had a run on deposits. They were closed down. So in aggregate, it's quite significant. I'm not going to dismiss it because when banks go bust, you go, But the aggregate size of those two banks was about $300 billion. JP Morgan, which we all know is the biggest bank in the world, $3.7 trillion. So they weren't even a tenth of the size of JP Morgan. And I would emphasize this is not a systemic crisis. This is not a Lehman event of 2008. Absolutely not. These are particular problems in particular banks. There may be other casualties along the way, but if there are, they're going to be relatively small institutions. Most banks in the US, UK, and Europe are very well capitalized now with no difficulties. So
bank failures sound scary as hell, don't they? I mean, do banks fail often? I mean, how many bank failures have there been in the last 22 years or so?
A little bit more often than you might think or feel. So in the US, there's been over 500 since 2001.
Really?
Remarkably high. Clearly, a lot of those were concentrated around the global financial crisis.
500 banks that were in existence in 2000 don't exist anymore.
Yep.
In the US. Crikey, that's that kind of puts it a bit in perspective. Yes, I understand that these are kind of substantial, but golly, wow.
Look, most banks in the US by number are pretty small community banks, localized, not very significant in the overall scheme of things. These two that failed last week were large-ish, but clearly not huge. They are. I think the Silicon Valley Bank was the 16th largest bank, but remember the banking industry is dominated by the titans: JP Morgan, Citi, Bank of America. They're the systemic banks, and if one of those fails, then you really run for the hills. There's no need to run for the hills when a $200 million bank fails. It causes ripples, and we had some ripples in markets. But the good news coming out of it, I think, and there is good news always out of all of these events, is that it almost certainly brings the monetary policy tightening cycle closer to the end.
Yeah,
it was getting close to the end anyway, but the Fed has probably done enough already in terms of tightening policy to take inflation right down. We're very confident inflation is going to fall quite sharply this year. It's been coming down a bit slower than people expected, but it's going to come down because the base effects are in favour now of inflation falling sharply, but energy prices falling very sharply, continuing to do so. You've had these supply chain disruptions that we all read and heard so much about. They've ended. That's now sort of gone out of the system to a large extent.
Yeah, I mean, I couldn't buy gherkins in Lidl. I mean, that's what I call the supply chain shortage. It's just
that's a real problem.
Yeah.
I feel very sorry for you, Clive.
But hey, if you can't buy gherkins in Lidl of all places, what is happening to the supply chain of the world?
Well, exactly.
That sounds weird, but there's all sorts of weird things you think, really?
Well, the big problem is semiconductors. There was a big shortage of semiconductors, but that's now ended. So there's now a surplus in some semiconductor areas. So all those sort of things are behind us. Inflation is definitely, economies are slowing, and there's no question about that. When you have monetary policy as tight as it's been, then you will get a slowdown in economies. But we're not heading into a deep recession or anything like that. There may be a mild recession. But the big thing is we're getting to the end of the inflationary cycle. It's coming down. We're getting very close to the top in the interest rate and monetary tightening cycle. Interest rates will be coming down by the end of this year. If economies do go into a recession, it's going to be mild. You look through into next year, and we'll be into a recovery phase, and there's quite a lot of potential then. So we're not alarmed by what's happening. Yes, of course, people are nervous when banks go bust, and they should be. And should look carefully at what's going on. But I emphasise it's not systemic. It's not a crisis. It's been handled very well by the regulators. Depositors have been protected. Shareholders have got nothing. So the banks, the institutions have not been bailed out, but depositors have been protected. The regulators have moved early, and I think very well, arguably better than in the financial crisis itself. So I think all of that is very positive. We'll get through this wobble in markets, which we've seen because of these bank failures.
Yeah.
Absolutely, yeah. But look, if you do get sharp weakness in markets, we would certainly be a buyer of equities, because you've got that potential then as we go through to the end of this year for interest rates falling, economies recovering next year, and corporate profits being so much stronger. So in a way, this brings the turn in the cycle that much closer, and we feel pretty comfortable definitely staying invested where we are. There's absolutely no point in selling into falls in markets. You want to be buying into these falls in markets. Yeah. It's creating opportunities.
It's interesting, yes. It's creating opportunities being the name of the word. It's fascinating that in our pre-video discussion, you were explaining about this banking scenario, and that their UK subsidiary, which of course has also gone to the wall effectively, smaller, but has been bought by HSBC for not very much money, like threepence or something like that. Gosh, that's a really good example of somebody saying, well, here's an opportunity.
Absolutely. Absolutely.
You know, let's buy a bank for a penny. Yeah, we'll do a bit of that. You know, why not? So, yeah, somebody's misfortune is always somebody else's fortune, isn't it?
Absolutely, yeah. I mean, absolutely. In HSBC's case, they have got it for £1. They've had to put some capital in to protect depositors, but it gives them exposure to what they call the innovative sort of sector, which HSBC has not been big in. It gives them a sort of a standing in that area. I think a couple of years down the track, they'll look back and think, well, that was actually terrific. That
was a good deal, yeah.
Absolutely.
Yeah,
absolutely.
I'd maybe just underline your point on inflation and how important that is. So in terms of our view that it's peaked and it's coming down from here, and central banks not having to hike so much. And why is that so important? Well, that underpins the bond markets. So if rates are expected to be lower going forward, then bond prices, all else equal, would be higher. And bond prices feed through to the valuations of all asset classes, particularly equity markets. So if the view is of markets, and it is our view as well, that rates will be lower at the end of the year than has been expected up until recently, then that's probably good news for equity markets as well. Now, you can worry about the growth scenario side of things and the recession and the like, but bear in mind that markets don't normally bottom at the end of a recession. They normally bottom well ahead of that, because markets anticipate the future. They move ahead of the slowdown in growth, the slowdown in earnings and the like. So whilst it's likely that the economic bottom is still later this year or sometime next year, maybe, when at the worst of that recession and before recovery takes hold, stock markets will almost certainly bottom well ahead of that.
But we've had a pretty good run over the last quarter. So we're talking about stock markets bottoming, and that's kind of
exactly,
yeah.
Yeah, no, exactly. So as we talked about in videos during the course of last year, markets had already discounted a huge amount of pain, which part of that was because of the inflation and rates side of the equation, but part of it was discounting the economic pain, particularly in Europe, and the impact of gas prices and pressure on the consumer and the like. But that was markets discounting and pricing in the pain to corporate earnings and to GDP growth across Europe, but also to an extent the US as well. So some of this that we're talking about, that we're anticipating coming ahead, is already in the prices.
Okay, see where you go. See where you're going with that. So good news where? China, I think you said.
China, definitely. China had a very, very difficult 2 years. The stock market actually more than halved in that period of time, up through to late 2022, clamping down on regulations with big tech, struggling with this big property development industry, a couple of defaults there, and then its zero COVID policy. Well, all of that now is behind us. Property development industry is getting straightened out in terms of its debts. They've done their regulatory tightening in big tech, and I think, as everybody knows, they've scrapped the zero COVID policy. So suddenly China is reopening.
Yeah,
and there's been a big acceleration in growth in China in the past 2 or 3 months. So the stock market has actually picked up quite a lot over that period of time, and it's important for global growth too, because China, of course, is the second largest economy in the world. So last year China grew by whatever it was, 2 or 3%. This year it could easily be 5 or 6%. That's going to have quite a big impact on global growth. At a time when the US and Europe and the UK are slowing down, China is accelerating. So again, it gives us confidence that if we do get a sort of a recession in the course of this year in the developed world, it's going to be pretty mild.
Okay. How about UK? Is the Sunak factor working?
I don't think it's working in the opinion polls yet. In terms of the next election, although it is still at least 18 months away, I think it's certainly helping in terms of stability of markets. The currency is strong. It's actually one of the strongest currencies in the world so far this year, held up well against the dollar. Bond yields, which spiked very sharply under Liz Truss, have come back down a long way. We've got a budget tomorrow, which I don't think will give anything away very much, but the noise is coming out suggests that there's some quite sensible things they're doing whilst maintaining fiscal prudence. So they're getting the sort of the government debt under control. There was a great splurge of debt through the pandemic. They're getting that under control slowly, and I actually think they've been doing quite a good job. The Sunak sort of Jeremy Hunt, who's the Chancellor combination, both sound sort of technocrats. And who knows? 12 months is a long time in politics, and things may yet turn around for them in the polls.
Yeah, I have to say, here in Southern Ireland, we noticed that he actually came to Northern Ireland, which seemed to be a really revolutionary new idea for British prime ministers to actually go there.
Absolutely, absolutely.
Which, considering their job, is like really.
And the stock market actually remains reasonably cheap. It's been one of the cheapest stock markets around the world. It's been doing well. It was actually up last year in sterling terms when most other things were down. And we still like UK equities. There are certainly plenty of smaller and mid-cap stocks that have been hit pretty hard that look interesting to us. And the UK has not fallen into the sort of the deep recession that pretty much everyone in the world was predicting.
And US, where we've got, I went hammering. I was on the motorway down to Dublin the other day, and coming the other way, there was the biggest motorcade I have ever seen in my life. About 18 outriders, 10 cars, and my companion is an ex-Irish Army security officer, and he said, "Bloody hell, is it Biden? Can't be. He's not due yet." No, it wasn't, but it was a Biden rehearsal for his visit next month.
Oh, was it?
Fascinating. Yes, they were rehearsing the idea that he'd have to fly out of Shannon instead of Dublin, so he'd have to go booming down the motorway. So, US president visiting Ireland and stuff like that. The world changes quite a bit very quickly, doesn't it?
Oh yeah, no, absolutely, yeah. Look, the US is a place you never want to underestimate. As Warren Buffett said some while back, it hasn't paid to bet against the US for 200 years. Probably won't pay to bet against them in future. It's a wonderfully vibrant place. Whoever's in charge can't stuff it up that much, I think it remains a great place to invest. And again, the economy's been doing better than people thought. It may have this difficult time that we've been talking about through the course of the next 6-9 months, but it'll bounce back. And it always does very quickly. Remains immensely strong. So
which is that same old moral, isn't it? You know, you and I have been here doing this forever. Fascinating. I did something very interesting the other day. I actually managed to repay my mortgage, which is a wonderful feeling. You know, Teresa went, wow, you mean we actually own a property? Fantastic. And I laughed and I said, that's really interesting. So I have owed banks money since I was 23 years old. That's 48 years I've been owed money. Some things never change. That's what I'm really trying to get at, you know. And as you and I have said so many times in the past, you know, what goes around comes around. What looks like a crisis is actually an opportunity. The cycle is the cycle. It does what it does. And Andrew, you know, the next generation along from us, you know, I bet you're saying the same thing. You know, guess what? It'll be. My experience told me that it'll do this all over again because I've been it. It just does, doesn't it?
It does. It does. Yeah, it does. No, I think the US is fine. It's a more expensive stock market than others, and there are pockets of it that do remain relatively expensive. There are parts of the tech industry that I think have still got some pressures on them, and the collapse of Silicon Valley Bank was reflective of that. There's still some challenges there, but there are also parts of the US stock market that are actually pretty cheap. So once we get through these next few months and we see inflation coming down sustainably, we see the Fed cutting rates. We think they will be by the time we get to the end of this year, early next year. Then I think we'll be in a very good position for actually a renewable market in equities, and it will almost certainly be led by the US as they always are.
And we're in a fundamentally much healthier environment as well, I'd say, compared to what we've seen over much of the last decade or so. So, case in point, you've got sensible interest rates, or vaguely sensible, 3, 4, 5%, whatever it may be. You earn a positive return over and above inflation in many cases on a forward-looking estimate of inflation. That's healthy. That's more normal. And one interesting stat from back in January actually was a couple of years ago. At its peak, there was $18 trillion of negative yielding bonds globally. So that's a Japanese government bond or a UK gilt or something. Not UK gilts, but European bonds were trading in negative territory as well. So investors are paying other people who are putting their money into bonds and receiving a negative interest rate back, which doesn't make much sense. But as of January, the last one of those moved out of negative territory, and everything now is in positive territory this year. So it just shows you how strange markets have been for so long, and it's not normal. It's not healthy for the spirit of investing and growth and fueling greater productivity going forward when rates are negative.
This sort of whole idea that hang on a minute, you don't make any money in the bank, so you have to do something, and you're kind of paying banks to look after your money as opposed to them giving you money for looking after your money, which is the right way around, isn't it? They are giving you money for looking after your money. Yes, jolly good idea. So we're back to that again. A jolly good idea. A real interest rate. Maybe.
Yeah. It was part of the problem behind the collapse of Silicon Valley Bank, incidentally, because they got a flood of deposits in the pandemic era from all these sort of tech companies that were raising money, as you know, very cheaply from private equity providers. All those deposits were placed, a lot of them with Silicon Valley Bank. They then, in turn, invested those in government debt and mortgage-backed securities at very, very low interest rates. Interest rates go up, value of those securities come down, and they were then forced to sell them at big losses when those little venture companies started withdrawing their deposits. So, there's always those sorts of things that come along in these cycles of monetary tightening. And here was a classic example. It may not be the end of it. There may be more still to come. But I would emphasize that it's absolutely critical. That these things are not systemic this time around. Don't let people tell you that this is another global financial crisis, because it's definitely not.
It's been a very painful year in markets in transitioning to where we are now, but investing from now, looking forward, you've got much stronger foundations and better expected returns from here.
I was going to, because that's brilliant, Andrew, because I'm looking at my clock and I'm going, gosh, we've got about a minute and a half left. I need the guys to come up with, you know, sort of the message. I think you just did it, didn't you, Andrew? That was the message. It's like, it may look odd, but it's a darn sight better than it was, and it's getting better all the time.
It will get better, absolutely. Yeah, it didn't get better last week when the bank went bust, but it's going to get better. I feel very confident about that.
Come on, you can't make an omelette without breaking eggs. Sometimes there's going to be casualties along the way.
Absolutely, absolutely. And actually, the sooner you get the casualties out of the way,
I can't feel sorry for a Silicon Valley bank somehow.
no.
Honestly, my heart doesn't break for a Silicon Valley bank. No, right.
No. And then you read incidentally that the chief executive sold $3.5 million worth of stock about 2 weeks before it went bust.
Yeah, right. Terrific. So listen, folks, there's the message. Gosh, it could look shitty, but it isn't necessarily. There's lots of good things going on. There is recovery. Inflation's going. Listen to what the guys have to say. Thanks, guys. It's been great. I'm really enjoying this. I'm going to let you go very fast because it's going to blink out any second. So goodbye and thanks from me.
Bye.
Thank you.
Bye.